Good morning and welcome to the Leadership and Insurance podcast. I'm very lucky today to be joined by Aaron Steffey, who is co-founder of Propeller Bonds. Aaron, how are you?
I'm doing well. Up and at 'em, ready to have a full day of meetings after this.
Yeah. Are you in some sort of airport hotel? Is that
Not an airport hotel, but I'm in a hotel in Kansas City, Missouri. We have a bunch of large broker partners in the Kansas City area. So just doing some in-person meetings, meeting some people that we've done business with for years and have never actually met face to face, stuff like that. So we got here yesterday, had some meetings, so it's been pretty cool.
Yeah, I only ask. You've got very large. I think it's probably a 747 over your shoulder or something. Or
Yeah, oh yeah. That's right. That's funny.
I was like, airport hotel. But it's so funny to talk about face-to-face meetings, isn't it? It's almost old-fashioned, but very much. I feel they're very much on trend again. I'm being asked to go and visit people now. It's I don't know about you, but I'm really enjoying.
I love it. Yeah, I like to socialize in general anyway. So being able to get out is awesome. And like I was just telling you, I have small kids at home and whatnot. So it's kind of nice to get a break and go be an adult.
Yeah, not a bad thing. But
yeah.
Aaron, before we dive into it, it'd be really nice if obviously we've introduced you from the top, but never better than coming from you. So it'd be really helpful if you could introduce yourself and obviously the Propeller Bonds business.
Yeah, sure. So the abbreviated version is I grew up kind of in an insurance agency family. So currently live in Philadelphia, Pennsylvania. My parents ran a very small mom and pop home and auto insurance agency, which after school I joined and was kind of working in it and wound up doing an MBA program to just kind of figure out like next steps in my life. And I wasn't sure what to do. So I did that at Villanova in Philadelphia. But I founded this company with my cousin, Chris Colger, who at the time was working at Chubb in commercial surety. And I was on the retail side, an insurance agency. And our agency didn't do a lot of bonds, honestly. We would just kind of trip over them as they came in, which was kind of an impetus for starting this. And so we would get together and I would kind of gripe about surety from my lens, the agent that's submitting the business and transacting the business. And he would kind of gripe about it a little bit from the carrier lens and his hangups. And, through some serendipitous things, we met our technology partners who sit in Australia, and we launched Propeller. And we launched Propeller 2.5 years ago. And at the time, we just set out to essentially automate what's called transactional surety bonds, just everyday, simple $100, $200, $300 premiums, but they eat up a ton of time for insurance agents that don't do it all the time. And it's super time consuming and on a low dollar amount. So there's a low ROI. So a lot of agents just ignore it, like my agency would. And when they would get it, you're piddling around with it for an hour or two to get, and it's a $30 commission item. And I was like, gosh, how can we streamline that? So that's what we set out to do. And then it kind of slowly, we launched during COVID, which was, interesting in and of itself. And so it kind of slowly started to mushroom, and then it's been exploding for the last 2 years. So we're an MGA. And the reason we launched as an MGA, surety, if we did a SaaS model, surety's so fragmented, there's only probably 100 customers that would buy a subscription software service to process their surety bonds. It's the 100 largest brokers in America. But being an MGA, we're able to, act essentially as a wholesaler for our revenue model, but we can give this away for free and clip the ticket on the way through. And so we don't get paid unless you love the product and you use it. And so we work with about 2,500 agencies currently. All sorts of shapes and sizes. So some of the largest brokers in the world, all the way down to little agencies like the one I grew up in. And we transact bond premium, not only transactional anymore, but large ticket items as well. So we've really moved upstream as far as our offering goes. And we kind of operate two sides of the house. So my cousin Chris is on the underwriting operations side, and I've handled the fundraising, marketing, sales, growth side. And it's kind of indicative of our personalities too. We're very much a yin and yang duo. And so that's kind of, it's been a really cool journey so far. And that's kind of where we sit today.
Fantastic. Thank you. Lovely, like natural split. I'm amazed how much that happens. I always think about partnerships or founding teams, almost like those games you have in the arcade where the coins just kind of fall down and they rest where they rest.
Yep.
I think that sort of naturally just happens. You go, oh, you're good at that. We didn't realize. Okay, you take that and then I'll take this. And it's really
Yeah.
good when they kind of complement. There's a few things I want to backtrack on there. And I think
Sure.
it'd be really interesting to framework, because this goes out. We were just talking about the distribution. I think you hit on a really important point. Surety means different things internationally, or certainly people's perception of surety. And I now you've gone upstream, so that kind of, I think upstream stuff is probably a bit more well known, the kind of big projects, civil engineering, that sort of stuff. But I think day-to-day surety in the US, what does that cover? Like, who's using that, who's buying that, just so we can get a real picture of exactly what you're doing.
Yeah, that's a great question, actually. So surety is kind of broken up into two silos. There's contract surety, which that is bonding a contract or a job, typically follows construction, but can be other things as well. And that's where you get the really large ticket items typically. The day-to-day surety that insurance agents and brokers, I say, trip over here every day, is what's called commercial surety, but it's mostly license and permit bonding, which means it's a bond typically required by a state or a municipality or a federal agency just to be able to get licensed to do certain types of business. And they're different in every state and every municipality. So an example that's a pretty oddball example is every nail salon in New York City has to have a surety bond in place that says they're going to basically abide by the laws and regulations of to get their certification or their license to conduct business. Same with contractors in every different part of America. Same with truck drivers, and to get their federal motor carrier number would have to have to be a freight forwarder, they would have to have a bond. So and those bonds renew every year. They're not fixed to a certain project. They're fixed to essentially how long you stay in business. So, if I'm here in Kansas City today, if I wanted to be a licensed electrician in Kansas City, they may require with my application proof of $1 million in general liability coverage and proof of a surety bond in an amount that they would desire. So sometimes it's 10,000, sometimes it's 50, sometimes it's 100. It's completely dependent on. So it really it's three parties involved instead of just two parties like a typical insurance contract. You have the carrier, the customer, and a government agency who stands to benefit if this person does not abide by the laws set forth in the bond. So those are typically small ticket, $10, $20, $30,000 bonds, but there's millions of them, and notaries need them, contractors need them, all the way down to odd obligations like the nail salon, and so there's about on our platform there's about 7,000 different types of bonds you can purchase in the U.S. and there's no set number, but it could be as high as 10 to 15,000 obligations throughout the U.S. Just based on wherever you're at.
That's super interesting, because the thing I was thinking about as you were saying that, which is, we talk about on the podcast insurance as a social good. I talk about with my team that we had a new starter this week, and I was sort of saying, no, you've got to believe me, insurance is more interesting than you think. The usual pitch. But essentially saying that business doesn't happen without insurance, and it's like the sort of liquidity of the situation. Bonds are such a useful tool for facilitating business in a way that would be unaffordable otherwise, because otherwise presumably you've got to put that 10,000 up front, or that 20,000 up front. So it really sort of bleeds into that kind of social good aspect of what insurance can do. And then you're leaning to that even further, because you're making that an easier play than probably was possible before.
Yes.
I won't ask you to comment on that, because I've just thrown you a
No,
ball.
I'll make a quick comment on that. Actually, I think that's a very good point, the social good aspect of it, because you're also allowing oftentimes smaller players, whether it's let's use construction, for example, you're getting them on jobs that they may not have ever been able to do if they had to put up $1 million collateral or $1 million in cash. So in the European market, they typically use bank letters of credit for this kind of stuff. And what surety bonds often do is replace bank letters of credit. So all that money's being tied up And in the US, we offload it to an insurance company for a 1, 2, 3% rate based on the financial health of the company. And that money doesn't need to be tied up. And it allows also, like I mentioned, a lot of times smaller players to get on bigger jobs, because they wouldn't have, the liquidity to post that in cash off to the side.
Mm. It really resonates with me as well. I've told this sob story a few times, but not on this podcast, but to people in recruitment that would understand this. We're a recruitment business. That's what we
Yep.
do. I was very lucky that I went into a massive insurance company that were building out their data science and engineering team. They'd never done it before, which sort of shows you the date of this. But this is when I first went into my first business, won the contract after a pitch. And essentially it was about, we were so young a company, and by young, I mean, we were less than 6 months old, that we didn't win it because they didn't believe that we were financially viable. Now, we were liquid, but a bond would have solved that problem. Like, if I'd been able to put up a bond or something like that, it would have really solved that issue. And I can't say the amount of money it was worth, because it would make me cry. But so I'm really supportive of surety and the way that it's utilised. And I don't think we utilise it enough in other parts of the world, but in the US, I find it interesting. One thing I want to talk about your background, Aaron. You touched on it there. Insurance background, of course, but not pure surety. Started with your cousin that has got this surety background, but the intersection between your MBA and launching your own business, and then going into a market that you are not necessarily as knowledgeable in. Presumably there's no accident there. Were you looking for a problem to solve at that point?
Yeah, there's two things. I didn't know how deep to go into that story at the beginning, at the outset, but yeah, I guess I kind of brushed over that. So two things, essentially. We were looking to sell the agency. And well, we weren't looking to, but we had offers to. And it was right at that right time where private equity backed buyers were just buying up everything, and the multiples were huge. And long story short, we never sold the agency, but we were looking to. And I was kind of thinking, oh my gosh, what's my next step? Do I want to be a broker somewhere? Do I want? So that's what spawned the MBA. But during the MBA, I met someone who put me in touch with another person, and I won't name them, but I consulted on an insurtech startup, and they just asked me to consult on, hey, it was going to digitize the E&S market was their charge. And I'm getting down the road with them as a consultant, and I'm realizing slowly but surely that the people I'm working with, they don't know anything about insurance, and it's no fault of theirs. That's why they hired me as a consultant. But I really, that was a light bulb moment for me, because I think that I'm part of maybe kind of like a newer next generation of insurtechs that are spawned from within the industry. So an insurance person, Raghav Tanna from Tarmika is another person that was at an agency and whose father had an agency that did it. And so I just that was a light bulb moment where I was like, there's a lot of tech people trying to get into insurance because they see, an opportunity, but they're not going to solve the problem the way they should, because they're not insurance people. They don't do it every day. And this was a problem specifically with surety bonds, where the total addressable market was not huge and whatnot, where it was really obvious to me that, this problem has to be solved from within the industry. And even the way we raised money, we announced our seed round recently. There wasn't a bunch of VCs involved. It was crowdfunded from strategic partners within insurance, because they see it and they're like, yeah, obvious. This is an obvious win. Whereas a VC, it's not obvious enough to them. And so anyways, that was kind of what spawned me starting this. I think like once that light bulb went off, I didn't just walk out and say, oh, I'm going to go start my own insurtech, but it was now in the back of my mind. That seed was planted of like, I was now going through life with that in the back of my head, looking for an opportunity. And then I was working with the city of Philadelphia and the state of Pennsylvania, some government officials, to do reverse flow business. So, European companies, coming into the US that might put an office in Philly, I would be a liaison for their insurance potentially, or I would get referred the business. And one day they referred our technology partners, our future technology partners, And I was just supposed to sell them insurance essentially, and sell them on why they should put an office in Philly. And I became really good friends with the guys, and it's called Axe Group in Australia. And I became really good friends with them. And over the course of time, we just were like, let's just do a JV. And they were kind of looking for their first customer in the US just to break in. And I kind of sold them on the idea of like, hey, let's do a joint venture. I don't know what we're going to solve yet, but there's this thing called surety bonds here. And I have a cousin that I could rope into it, and it could be an interesting play that we could really, do something cool with. And that's what started this long journey. And we were building it about a year before we launched. And one quick sidebar for that, so surety bonds prior to COVID, historically, they've always been an in-person deal. The city or the state or the government official wants it to be sealed, and you'd have to go down to the place and turn the bond in. And over the course of the last 5-10 years, about 20 states started accepting electronic signatures, electronic seals, et cetera. So when we were building this out about a year before COVID, we were building it out just for those 20 states. And with the idea that over the course of time, more states will, be added. And then literally right at the day we launched, or the day we were going to launch, COVID hits, but all 50 states started accepting electronic signatures overnight, because no more in person, no more going down, no one had printers, no one had seals, everyone was home. And so the market came to us in a lot of ways. So there was some serendipity there, where overnight, we had the solution. It's almost like we had, built it for COVID. And, that was kind of a cool aspect of it.
Yeah, that's interesting. The impact of COVID slightly resonates with us as a business. We'd always done US, but it always been much harder, because you always lose out to that person that could be there physically, and then all of a sudden you went, well, this square of real estate is the only interaction we're ever going to have. So my pitch was accepted alongside other people's who might be US based. So it was kind of interesting how those things changed. I wanted to dive into your sort of view on the investor landscape. So it's quite interesting. I knew about the raise, but I didn't realize obviously where the money had come from, but sort of the crowdfunding aspect. But surety is definitely an underserved market as far as the kind of my view from an innovation perspective. Is there a change? You've obviously sourced it from within the kind of insurance industry, but do you think there's a kind of changing investor appetite in insurtech? I think if you pitched it now, I think you'd get a lot more traction, because people are less interested in this massive total addressable market, but they're more interested in kind of like niche products that solve a problem. Do you think there's a changing appetite for investors now?
Certainly. Well, I think the biggest change though is, so surety, both our company and the surety industry as a whole is very profitable. So we have a clear path to profitability, and we're not hemorrhaging tons of money every month. And so I think investors, there's actually, there's a huge stockpile of cash that's going to be invested, but I think what's changing is their due diligence on these companies, that, you're starting to see the insurtech layoffs and whatnot, that, and maybe some of them never really had a true path to profitability and just thought the well would never run dry, and you just raise more money and raise more money. And I think investors are now going to put a big emphasis on that path to profitability, and that there's a sustainable business here. And so that has changed, but surety is always, so right now underwriting profits are down because of supply chain, because of cost of claims, everything. So surety is white hot right now. Like everyone wants to get into surety when underwriting profits are down, because surety historically is super profitable. So our loss ratio last year is like 2%, as opposed to, a cyber MGA that's 90% losses. And so they have a bigger pie, but is the underwriting profit really different? Like we can underwrite more profitable on 20 million worth of premium as opposed to 100 million. And so, so, and then when you see that underwriting profits are flush and all the carriers are doing great, surety is kind of casted aside. And so it's an interesting kind of play. I think my cousins last year at Chubb, surety made up 4% of the revenue and 19% of the profits. So I think that, it's one of those things, and they get the crumbs of the IT spend oftentimes. And anyways, to answer your original question, I do think investors will continue to hone in on profitability and therefore I think they will continue to lean into surety, because there's just and other niche lines of business that are proven to be underwritten for profit.
Mm. It's fascinating for me from in my role. So, you know, a lot of what I've done in the past is move teams of underwriters to, you know, and one of the places to find them, one of the most profitable places for them to find themselves is setting up MGAs. So we've supported a lot of the big MGAs in the past and a lot of the kind of
Yeah.
global MGAs. And what's interesting for me is that the investor profile of like the quote unquote insurtech market is now trying to sort of almost matching the investor appetite of those MGAs. Because if I went up to any of my sort of MGA partners that we worked with in the past, it would be find me niche products with like where there's a unique proposition you can put together in profitable markets. And surety fits all of those kind of equations. It's quite interesting how that now mirrors what the sort of insurtech investors are looking for.
Yeah. Well, and there's a true need. Like, I mean, there's a need for it for like our product. You know, there's a true product market fit where agencies need this. They need to be more efficient. And then you, in a rocky economy, like we are, you could say we are now, you know, a lot of insurance agency owners or brokers will cut the cord on the nice to haves, maybe some of the SaaS stuff or some of the things that were, you know, they provided a little bit of efficiency and they were nice to have. But we're finding that in this economy, we're being even embraced more because it's an efficiency play. And it, you know, they need to get more efficient. They need to get leaner on their labor costs and whatnot. So we're finding that we're being embraced even more. So that's been really cool to see as well.
That was going to be one of my questions actually, because so my understanding, and before I leap into this question, because I suddenly realized that I very kindly spoke to your head of growth a few weeks back to get some background, Taylor. But and she was brilliant. And but tragically, I don't think my notes were up to scratch. But my understanding is you're utilizing existing broker or agency distribution, right? Wait. I was interested about the demand from those brokers. Are you finding that it's being more utilized by brokers that have done surety quite successfully, but just have a demand for digitization and efficiency? Or are you finding more demand from brokers and agents that have not really previously done surety, but now you've got this kind of streamlined solution, they're open to offering it? I just wanted to sort of understand about the balance of kind of demand really in terms of what you've been finding.
It's all of the above. It's it's a little bit of everything, and you never quite know where it comes from. You know, I think what we've noticed is we get it from all over. So I always tell people, you know, product market fit's great. So say we do 100 demos, we're signing on 95 agencies. But how they use us are different amongst agencies, right? So to this mom and pop agency, we are their full bolt-on surety bond department. They need markets, they need tech, they need people, they need to understand what the customer need is. We're there. So we act as their complete surety bond department. To the large national or global brokers that we work with, which we work with most of them, they look at us more as their transactional department of anything below X amount of premium. We don't really want to touch it. We're not staffed for that. We pay people too much money to be processing $100 bonds manually. So Propeller, they're our transactional unit. So we see it kind of all over. And that's been, you know, I think like by the end of this year, we'll be close to 5,000 agencies using the platform. And that's what's cool about our product is we can onboard new agents for next to nothing as far as cost goes. So a lot of these agents, they may only do 10 new bonds a year, 5 new bonds a year. And a carrier is not going to go appoint them for that level of volume. It costs too much for them to appoint them, but we can do it as an MGA. We could sub-appoint everybody for minimal cost. And that's okay if you only write 5 or 10 bonds a year. We'll take 5 or 10 bonds from 5,000 different agencies, you know, and be a home for it. And it also allows us to get them better, you know, right now, cannabis is becoming legal pretty much nationwide here. And all of these cannabis licenses are coming with surety bond requirements as well. Cool. And we have a specialty carrier that does cannabis that most agencies would have to do, you know, $250,000 or $500,000 a year in premium with them just to get a contract. But through us, they can go write one cannabis bond a year, and they get, you know, 30, we pay 30% commission to all of them, and they have no production requirements. And so that's been, anyways, I got off track there a minute, but it's just a long-winded way of saying we get it completely from all over the place, every shape, size. It's, the demand's kind of everywhere.
That's super interesting. I think that's I was wondering how that reflects against your thesis, because you obviously started with this is where we're going to get the money. Does that match that, or did you chase the big sort of broker relationships first? What was your view?
I chased, man, that's funny. Yeah, I mean, because the first year,
Anything.
The first year I was the guy in your LinkedIn messages. You know, I was always, I mean, we had to get it off the ground. So
Yeah.
at the beginning, I think I chased more larger agencies because we needed revenue in the door. Like we needed revenue just to stay alive.
Yeah.
As time has gone on, we've worked more and more with smaller agencies, and it kind of runs the gamut. But honestly, early on, our thesis early on was appoint everybody. It was, we want to work with everybody with no production requirements. You know, we want to do that. Where it's coming from, we're starting to hone in on different things. I mean, the larger brokers have more volume, for sure, but you have to find efficient ways to go about working with them, and it's a longer sales cycle. You know, it's kind of a long time. So I would say that the thesis has always been that we want to work with everyone. We want to be agnostic, and we want to be, you know, completely I mean, to be frank, like we want to be the world surety bond department, you know, because too many people don't do enough bonds to warrant having someone in-house or someone, you know, an actual department. Now, these large global brokers, they do, but there's some pretty healthy size agencies in the US that still don't have a surety bond department because they just feel like they don't do enough of it. And so that's what we want to be, is this bolt-on surety bond department. And you don't take any haircut in commission, because that's always a thing with MGAs or wholesalers, right? Like a lot of people feel like, oh, we only go to them if we can't place it with our standard carriers because it's, you know, a clunky process, or it involves less commission. With us, it's actually a faster process, and it's the same or more commission. And so that's really what we're kind of positioning ourselves as, is this bolt-on surety bond department.
Yeah, love that. What a great way of pitching it as well. Because then size and scale is irrelevant. We're that bolt on for you. I know that one of the things that I was interested in as we go into this world of insurtech a bit deeper, we look at MGAs. I think a product like surety is fascinating for me, because we discussed just ahead of time, is it an insurance product? Is it a financial instrument? You know, is it both? Now, you could probably give me the academic answers to that, but what I find interesting about that is the appetite for a product like that, particularly with the profitability that you can show from an underwriting perspective, the results. It has the ability to attract like non-traditional sort of carrier partners or capacity providers. Do you see that down the future? You know, you could see hedge funds being interested in this, or kind of other sources of capital, but really.
I think private equity for sure. I mean, just in people we've talked to, I think private equity is definitely hot on it. Reinsurers, family offices have reached out, you know, a time or two. So yes, I think anyone that is interested in getting into insurance in general, that's an outsider today, it's a good place to start because of the profit levels. And a lot of the underwriting on the smaller ticket stuff is not complex at all. It is not, you know, it is, a lot of the stuff is instant issue, and a lot of the smaller stuff truly is a commodity. And so when you're dealing with the commodity, that's where our whole thing was. Then what matters is speed, because an agency can get $100 bond from Travelers or Liberty Mutual or whatever. It's $100 across the board, but it becomes how fast can you get it? And that's where we won. And so to answer your question, yes, I think that a lot of non-traditional players are looking into getting into surety. And whether it's, again, reinsurers, private equity, family offices, I think that we've heard a lot of different feedback. And, you know, there's also, you know, foreign insurance companies that want to get into the US surety market as well. So we're starting to see some of that too. So I think a lot of that.
that must be well, that must be a good weapon for negotiating your renewals of contracts of MGA partners. You know, weapon's probably an aggressive term for you to agree to, but what, you know,
Yeah.
it's a good string to your bow, I would say. Does that play into those conversations? And have you kept the
Yes.
same carrier partners throughout?
Yeah. So we've added carrier partners, but we have like some core ones. We work with all the people you've heard of, you know, Liberty, Travelers. Arch is a very big partner of ours. We love working with Arch
Mhm.
nationwide, and then several others as well. And so it definitely is. I mean, like negotiating for revenue is one aspect of it, of course, but then also one of our biggest negotiations is always just like instant issue threshold and making it easier, because the easier the carrier helps us make this to place the bond, the more the agent's going to love it and use it. So there's a real kind of push pull there. And then yeah, I mean, I would say that certainly there's revenue to be negotiated on the back end, and we definitely do have bargaining power, but it's mostly due to the fact that we take all of the lift off of the carrier. I mean, we handle the billing, the distribution. They have the carriers that work with us love us because they have one contract with Propeller Inc. that to access 5,000 agencies. And they could never get their arms around all of those agencies and manage all of that, and manage the onesie twosie bonds that come in from different. And so we're very valuable to anyone looking to get into surety, because, you know, when you want to get into surety, you need distribution, a huge amount of distribution, and then you need technology and a team. And that's what we provide is distribution. It's our team, our tech, our distribution is always on our pitch decks. And that's our three core things that we provide to any capacity provider that wants to get in. And yeah, so it definitely is a power position for us to negotiate from, for sure.
Great, that's great. Yeah, I was thinking that it's such a great distribution play. I mean, I'd like to say it's a no-brainer, but we say this on the podcast all the time. Like the ideas that sound the simplest and they're solving the most obvious problem, you know, it's usually
Yeah,
the best. You don't have to dig that deep. You're like, right, this is what
no,
we're able to do these things for you at a cost-effective point that you couldn't do yourself. Because
no, it is a very simple solution to a very complex problem.
yeah,
And that's kind of what it's been. And then also in the distribution, just allowing, I don't know if you know this about our product, but there's no login. So what it allows is the agent to transact the bond, but also it can be customer facing. And so we're getting, there's no, and it's not impeded by a login, and there's no need for that. And that was something we did on the agency side. So now an agent can have a button in their email signature or a button on their website, or they could post it on social media. Anyone who buys a bond through their unique URL, they get commission, they own the relationship. And so we're launching our embedded solution pretty soon, where we're going to actually be able to embed the bond purchase process right into other folks' ecosystems, websites, working with other MGAs that are tackling commercial insurance to be able to bolt on the surety solution with them, and they can have a passive revenue stream, all that kind of stuff. So that's been a cool kind of evolution of our distribution model for sure.
uh, on from that, Aaron, there's something that just came to my mind here, and this is just a position of ignorance. So please forgive me if it's a stupid question, but in surety, is it more of a battle? It feels like it's less a battle for price, because these are kind of not
Yeah.
particularly expensive bonds. They have to be done because they're sort of mandated by the state or the government. And it is a battle for distribution. Is that fair to reflect on, particularly that kind of small everyday transactional bonds?
Yeah, because there's no, with typically carriers are competing on coverage and price.
Mhm.
And price is pretty much the same across the board. There's some variations, but pretty much the same
Yeah.
across the board. And then coverage, there's no coverage in this. It's just because you're not getting an insurance policy, you're getting a bond from the city,
Yeah.
or to the city. And so it's just saying that they will post this money per the city's obligation. So
Mhm.
as long as you have an A rating and you're financially, capable of handling these claims, if had, then you're good. So it really does become about speed and distribution, and that's our entire model, is distribution and speed on the
Well,
small ticket stuff.
Yeah, which was what I thought was so fascinating about it. It's like the perfect embedded play. Like embedded is like everything. You're like, right, where can we
Yeah.
distribute via our partners where they've got the relationship, or how close
Mhm.
can we get to the customer's decision to, once you've said, right, I'm going to be open a nail salon, you need this bond. Like it.
Yep.
So what's the closest touch point that they could hit on that they need that bond? And because if price is ubiquitous, then it doesn't. It's just like who's going
Yes.
to get to them first, really. So
Yes. Yeah.
um,
It's embedded. It's made for embedded. We've gotten several requests from our broker partners to do this, where we can embed it in law firms for probate bonds, or we're not doing this, but to drop their name, like a company like Home Depot, for contractors, like you can embed anywhere the solution lives. We could easily embed an application, and it's quote bind issue almost every time on the small ticket stuff, where you can literally buy and print your bond within 1 minute.
Awesome. What does that mean for partnerships with other, it could be another insurtechs? I appreciate there's probably more partnerships with not insurtechs, but I'm thinking of companies like, I don't know, Varuna run an agency kind of management platform. Is that something that you, in your growth role, presumably you've explored that? Is something that's relevant to what you do?
Yeah, we're starting to. Really, it's been more like, so we did a partnership with Tarmica and Bold Penguin. Bold Penguin I think should launch fairly soon. And we just did one with Vouch and MGA. And
Yeah.
so I think we're starting to figure out where we live in that world. But yeah, it's oftentimes, I mean, other insurtechs we'd be open to as well. But for a long time, we didn't have the embedded solution ready. And a lot of those companies don't want the customer to leave their ecosystem to buy the
Yeah.
bond. So they want it to be embedded within their ecosystem via API or some sort of wireless iframe, which we've developed. And we should launch that here in the next, like, I don't know, 90 days or so. And I think that's when we'll really start to see us play with more insurtechs, and being able to kind of embed ourselves in there. But yeah, that's totally where it's going for sure. And I think our main distribution channel will always be our agents and brokers. And even if we did an affinity play like a Home Depot or something, we would slide an agent or broker in between that relationship. We're pretty steadfast about going, like, we're big on the agency stuff. We're never going direct. No, never have had any intention in going direct. So we're like all in on agent broker channel.
Because even that affinity relationship, there's then a demand on you as a business, isn't there, to manage that relationship and deal with that. If you put the agent in the middle, then you might already have any pre-existing relationships. It's a smart model. One more question, Aaron, and I'll probably let you go. I'm intrigued about,
Sure.
we've been focusing more on the sort of day-to-day transactional bonds that you've discussed. But I know you've pushed up, as you said right at the top, into some of the sort of bigger ticket. How big are you going, and is there a limit to where you can go with the constraints of either your capacity or technology?
No, so yeah, I mean, we just put a $20 million program together for commercial bonds. I can't say who the company name is, but we've taken on several publicly traded mortgage brokers, where they have to have mortgage broker bonds in every single state in America. And it gets pretty, you're talking about 10, 20 million in capacity. So we do all of those. I would say that the technology, doesn't underwrite for that. That's a human touch. So on those larger ticket items, we still streamline the submission process and take care of all the billing on our end and the issuance of the bonds, which is still a heavy lift that we're removing from the agent. But in between there, that's when there's a human touch, and our underwriters actually review copies of the contract and underwrite the bonds. If it's outside of our box as an MGU where we have the PIN, then we have to submit it to our carrier partners and have them take a look at it. But yeah, that's typically how the larger stuff. And honestly, I think, like, we're getting a lot of looks on the larger stuff, because the technology does still streamline some of it and organize the billing and everything. And then B, I think that we're pretty white glove service on some of it, where I think and then I think the other thing is, we're still an appetite aggregator of carriers. So this $20 million program that we got if you're a broker, you can submit it to 10 different carriers on 10 different applications with 10 different indemnity agreements, or you can submit it through Propeller and we go do all of that work for you, and it's one submission. So that appetite aggregation, I think really helps a lot too. So that's kind of, you know, an element of why we're seeing some of the larger ticket stuff on the construction side, and then also on really large commercial surety programs.
Awesome. And we don't want to overstay our welcome because I think we've hit the 50-minute mark, but what a brilliant conversation. Thank you so much for taking the time out. I know you're a busy guy, and obviously you're traveling at the moment away from the family, good or bad depending on the day. So I really appreciate it. Are we going to get to see you at any of the InsurTech events this year? Are you coming over to London, or? It
sounds like it. I was talking to Sophie. I would love to get back to London. I was able to catch a Premier League match last time I was there, and I absolutely loved it. But I will be at InsurTech Insights in New York. It sounds like you might be there too. So yeah, we'll have to get together.
All right, good man. Look, I'll hold you to that. Aaron, thanks again for being a guest, and yeah, really appreciate you being on the Leadership and Insurance podcast.
Thanks, Alex. Appreciate you, man.
Thanks, bud.